Hey, what's up, everybody? It's Jason Ike Miller from Reverse Mortgage Reality, and today we are going to learn all about the wonderful and maybe not so wonderful, we'll see where we take it, the wonderful world of long-term care planning. And I've got my good friend and financial advisor, Leland Jefferson. He's on with us, and I don't Look, if you've watched this channel, you know that I know I'm good at two things. Number one is mortgages. I think I'm terrific at that. My clients will say that. The other is chasing my kids around the backyard. Everything else, definitely not an expert. So that's why we bring the experts on so they can teach us a little bit and open our eyes. So Lee, thanks so much for coming on, brother. I
Thanks
appreciate
for
you being
having me. Excited to be here.
awesome. Awesome. So yeah, can you give us you know what? Tell us how you got into the wonderful world of long-term care.
Well, thank you. So I've been licensed over 20 years in insurance. I've done auto, I've done home, I've done disability, did group health, and then I really started getting into more life insurance. And what I found out is most of my clients don't have long-term care and they're looking for a way to get long-term care, and sometimes they want to combo their life and their long-term care. So they either want a standalone plan or they want to do a combo. And so basically my 20 years in the insurance business brought me into serving seniors on their life and then helping them with long-term care. And that could be a combination or it could be a standalone, but it's just kind of evolved into that. And there's a massive need for particular people who are 50 up to get some kind of a coverage to take care of what they're likely going to need.
Gotcha. Why do they need it though? This is such a simple question,
Yeah,
but like why do we care? What's important about long-term care protection?
right. Well, the odds are you're going to need care. Now, it could be a family member, or it could be somebody like a nurse's assistant, or it could be assisted living, but you have a 70% chance requirement of needing some type of care. The problem is, excuse me, the problem is it's not cheap. You can pay out of pocket, but Medicare does not cover long-term care. That's one of the biggest misconceptions.
Hmm.
Medicare, when you turn 65 and you're on Medicare, that's not going to cover long-term care. Medicaid will cover long-term care, but the big problem is you have to be impoverished. You have to be basically poor to get the government to pay for your long-term care. Now, do you want them to stick you where they would stick you? Because they're going to put you where it's the cheapest or most affordable place they can put you. So if you think that Medicare is going to cover long-term care, it's not. Medi-Cal in California or Medicaid will, but the requirements are you basically have to have no assets.
You have to be broke. Yeah, I've worked with some Medicaid and some Medi-Cal as well, and the overwhelming theme, again, I'm not an expert at this. This is why you're here. Um, is yes, you have to be broke. And then people will say, well, should I stop spending and have a plan to possibly to become eligible for it later on? And I think again, high level, talk to the experts about it. Yes, maybe, but you don't want to be eating cat food so that you have a possibility of maybe getting it in the future if you need it. Cat food doesn't taste good, or dog food.
Yeah, and I personally I care you care about your clients, I care about my clients. I want all my clients to be comfortable, to be
Yeah.
comfortable. My seniors who are in retirement, I don't want them to be destitute. I don't want them to be impoverished. I want my clients to be comfortable. And there's ways that that can be done, especially if it's planned ahead of time for what's likely going to be needed. So I want my clients to not call me in their 80s dealing with impoverishment or not having enough care. I want everyone that I take care of, no pun intended, to live a comfortable life, and likely we're going to live into our 80s at this point. So if that's the case, I don't want any of my clients calling me in their 70s or 80s having a financial burden or not knowing how to pay for getting in-home care or care in a facility, either way, whatever that looks like.
Yeah, sometimes it might be easier said than done, but like my whole thoughts, especially on the reverse mortgage side of things, is hey, you have this branch of the money tree that you haven't used yet. It's your house. You probably haven't even thought that you can safely use it, which is why you're reaching out to me to figure out how to do that. But most of the people that I speak with, once we get from kind of like their highest like 10,000 foot level, once we get past, oh yeah, we've got to pay this thing off or we've got to fund this policy, which you'll share with us about a little bit later. But they just want to live, they want to feel that weight off of their shoulders. A lot of people, they're not really stressing living in luxury, although some people do this sort of stuff to so that they can travel, which is a great idea, by the way. Travel while you can, have those experiences, see those sights. But in the end, it's not waking up at 3 a.m. thinking, "Oh my God, the bills are due next week. What am I going to
Right,
do?" Or I'm draining $3,000 out of my investment accounts, and Leland's telling me, "You can't keep doing that. It's going to run out."
right,
So just being able to like it's this, right? Retirement should, right? Sometimes
right.
it's but should be about this. Kick back, enjoy.
Yes, exactly. And a lot of people don't know they can fund their long-term care through their reverse mortgage or through a cash out refi. They can take care of that. And why would you do that? Because of the multiplier. If you hand me $1 and I hand you $6 back, you meet me on the street, you hand me $1, I hand you six. Why wouldn't you do that, right?
I'd be scrounging like the trash cans for pennies,
I know.
like borrowing from, hey, can I get $1? I'm going to turn it into six. Let's go. So how
Mhm.
does that, can we go down? Do you have like examples? Can we go down the rabbit hole of kind of how that'll work?
Yeah, I have some slides if you're okay. I can show a few things
Yeah.
for your audience here. I'm gonna go ahead and share my screen if that's all right, and then
You're the teacher, man.
I can show you
Absolutely.
some real numbers. So I'm gonna give an overview here. This is a quick long-term care overview. I could spend all day on this, but I don't want to wear people out. So here's
Mhm.
an overview of long-term care and some quick stats for you. Someone who's 65 right now has a 70% chance of needing long-term care.
Whew.
And of those needing care, 40% will need it for 2 years, and 22% will need it for 2 to 4 years. So there's a strong chance you're going to need some kind of care in the future.
Can I ask you a question about that real quick?
Yeah,
Of the 40% that'll need it in 2 years, and it drops down to 22, is that because like it's a lifespan thing? Once you get long-term care, then you have about a 2 year kind of like life expectancy? Of
yeah, you're looking at the last couple of, typically speaking, not everybody, but typically
course.
speaking, you're looking at the last couple of years of your life, basically.
Got it. Okay, I got you.
Yeah.
Just
And these
somebody might have
stats,
that
right?
question.
This is kind of mind-blowing to me. This is coming from Lincoln. I was on a meeting with last week with Lincoln. These are just coming straight from Lincoln. 76% will be female. Of the people making claim, 76 will be
Hmm.
female, 24% will be male. So
Hmm.
guys tend to drop dead, although many men will be on the claim, but 76% of the time the claim is going to be a female. Average age is 83. So we're looking
Okay.
at the last 2, 3 years of your life, typically. Top reasons for claim. This blew my mind. 59% is cognitive, which means we're talking Alzheimer's or dementia. Most of the claim is cognitive. 8.6% is musculoskeletal. Then you got nervous.
They're hobbling around like me.
Yeah,
They're tough and I'm 40.
exactly. I need physical therapy, so I gotta watch it. So
Yeah.
this is sports injuries for me.
Hmm.
Circulatory, stroke. My dad had a stroke a few years ago. Those are typically what you're looking. These are the stats straight from Lincoln, but it's amazing how the vast majority is a cognitive impairment.
Wow. Is
Here's
that
some
kind of
more.
like is that a type 3 diabetes type thing? I know we're kind of going, I don't want to go too deep into
Well,
medical. Stuff
Cognitive is going to
then.
be you're just not firing on all cylinders upstairs. You've got dementia or Alzheimer's. You've got
Mhm.
something that's just not. You could be running triathlons, bench pressing 500 pounds, but if your mind is not totally conducive, that is a risk for your health.
Mhm.
If you leave something on in the kitchen and now there's a potential fire risk. These people need care, and the majority of people going on claim, they might be perfectly physically healthy, but mentally they've got some type of maybe Alzheimer's or dementia or risk of self-harm because of a mental faculty issue.
Gotcha. My wife leaves the stove on all the time. My job is to, whenever she cooks something, afterwards, I just mosey on over to the stove, like, ah, yes, it's
Well,
off. Good job, Bridge. Way
oh
to be.
yeah, oy vey.
It's starting.
Yo, oh yeah, boy, I'll pray for you. Yeah, that's
I
she's
need
too
it.
young for that. So but these are just the raw stats
Mhm.
of what's going on out there. But I was blown away by the vast majority being cognitive. Here's some other stats where the money is going. Long-term care benefits, 47% of all that's going to home health care, which makes sense. Most people don't want to leave their home, especially men like us. We don't want to leave our homes. We want someone to come take care of us here. And maybe that's a family member who's getting paid, but we want to stay in our homes. After that, then it's assisted living, and then it's nursing. So nursing is like the last resort, but most claims start at home. Most people don't want to have to leave their home.
Yeah, I've done over 400, I think right now, 470-ish reverse mortgages, and I've yet to find somebody to say, raise their hand and say, yeah, yeah, you know what? I'd like to forget staying at home. I'd like to go to the state-run nursing home, please, to live out my life.
Yeah, who
No
who who
way.
wants who wants that? People want to stay in their homes as much as possible. Now, at some point, it may not be possible, but as much as possible, people would like to stay in their homes, and this is one way they can. So, if you're doing a reverse mortgage, you're doing a cash out refi, you want to stay in your home for the rest of your life. This is one way that you can stay in home and still get care.
Yeah.
Now, here's where things get really. I'm gonna try to move the picture in picture. Here's some really interesting stats. Cost of care in your area. Genworth has an awesome calculator, and you can go on their calculator and find out what does your area look like. So I'm just going to bring this in. So if I'm living in, let's just say Tampa, Florida, okay, I'm,
Yeah.
I'm putting in Tampa, Florida here, and I want to know what is the cost of care in Tampa look like. Well,
Wow.
I want to stay in my home, and here's in-home care right here. For 2024, in-home services. This is not Genworth per se. They're just running the study. When they
Mhm.
run Tampa, they're showing in-home maker services. Last year were 59.11. Okay.
Now, real quick on that 5911, I don't
Yep.
know, diving into the details a little bit. Do
Yeah.
you know, by the way, this website, look, it's carescout.com. I
Yeah.
didn't even know about it. Yeah, if there's a way we can, whoever's editing this, if we can put carescout.com, I think that's going to be really
Yeah.
beneficial for us. But
Yeah.
is that 5911, what sort of hourly? Because that's not 24/7,
Yeah,
or is it?
in-home care, I believe that's someone coming in every day, and that could be, I don't think they come in for less than 4 hours. So if you're
Yeah.
getting in-home care, you're having someone come in every day for at least 4 hours. I don't
I've
know
seen
what,
some disgusting, like just through doing these reverses to fund the home health care. I do this a lot. When I talk to the owners of the health agencies or the adult children, um, I can see bills right now. I'm not arguing with this at all, but a lot of these people, they start with 4 hours, 6 hours or so, and their kids are helping out, but then their kids get exhausted and they can't do it. I think the evolution is to 24/7 care, and maybe you can get some sort of statistic on it, maybe not, but that is ridiculous. The cost is at least five figures a month from what I've seen, just really across the country too.
Well,
It's
what's really interesting, Jason, is the evolution of AI.
mhm,
Okay. And what's going to be happening in the future? Are robots going to be taking care of us? Because that
maybe.
could help. That could help because home healthcare obviously is not cheap, but
Yeah.
we could have some kind of technology to help with some of these costs. Tesla's robot might be, putting you to bed. I don't know. But there's a lot of things coming that could help with these costs because we don't have enough people basically to take care of the elderly. We have a healthcare deficiency basically for seniors.
Yeah.
But in-home care might be the first starting place, and then adult daycare in Tampa doesn't look so bad actually. Adult daycare looks pretty reasonable. But where things really get tough, and this is really like the last maybe few months of someone's life, or maybe a year if you're a female, but um, a nursing home. This is where things get really pricey, is looking at nursing care. And this is across the whole country. I've run the same calculator across the country multiple times, and it's not cheap anywhere. Some places are obviously more expensive than others. Uh, but nursing is where things get really costly, and people drain their retirement or their 401ks or IRAs because they got to pay for this stuff, which
They
is,
blew through all their money, man.
yeah,
Telling you experience. I had family, grandparents actually did it. They blew through a lot of money. My mom's mother before she passed. And so I can tell you from just personal experiences. And then my mom was still flying down to kind of take care of her until the end, but it was still incredibly expensive just to have like the part-time caregiver. It was just a CNA. I think these
right,
statistics, this isn't skilled healthcare. This
right.
is just people help you bathe, but it's nothing like crazy, ridiculous or complicated. It's just so much damn money. But yeah, I've seen people come to me after they've blown six, not blown, but like spent because you're not really blowing it if you're using it to stay at home, but spend over six figures just over the years doing this. And it's just it bankrupts you, man. It's so hard.
Yeah, it's sad because you've worked your whole life to build up your retirement assets, and now
Yeah.
it's being blown on stinking healthcare. And so you can see this for your own area. You can put in your location. We can put the link in the below the video, wherever the video is going to be, so people can put their own area location and they can see what their area looks like and get an idea what care costs are in their area.
CareScout.com. CareScout.
Care
I like
Scout.
literally never even did. I didn't even think that was a thing until
Yeah,
45 seconds ago.
and that's coming from a Genworth runs those studies.
Yeah.
Okay, so here are your triggers. So these are your long-term care triggers. So if you have coverage and you're ready to go on claim, these are your two out of six of these: bathing, dressing, continence, transferring, toiletrying, or eating. And I just learned in a meeting, eating means from the
Yeah.
table to your mouth. So if Jason, you need someone to prepare your SpaghettiOs, that doesn't count. It's
I
from
do actually. I can't cook anything. I'm just terrible, terrible at it. So I
so
got one, but
yeah.
maybe I don't.
If I'm coming to your house and I'm your caregiver and you can't open your SpaghettiOs at 85 years old, that doesn't qualify. It's, can you take a spoon of your SpaghettiOs and put it in your mouth? If you can't do that and you need help with bathing or dressing, you got two of these, then you qualify to go on claim for your coverage. Or the real biggie is cognitive. You've
Mhm.
got dementia, you've got Alzheimer's, it's game over. Okay. So if you've got two out of the six of these first ones, or if you've got severe cognitive impairment, you can go on claim and you can start receiving benefit on your long-term care.
Got it.
Yeah. Um, and then there's two types of care. This is where things get interesting. Long-term care used to look like, and it still does, it used to be just a use it or lose it. So if you never go on claim, the funds that you've been paying are just gone. It's just like your auto insurance. If you never, crash your car, there's no money coming back. It's a lower initial premium, but the price could go up. Now, if you're going to be holding a plan for 30 years, if you living to 100, then there's a strong chance you're going to have a price increase. You can pay monthly, you can pay annually, and those rates are based off your age and your health. Now, some folks have complained saying, I don't like my price going up when I'm already on a fixed income, already a senior, and I would like to have an alternative. And that was the advent of asset-based care. Asset-based means it's connected to either your annuity or your life insurance. If you don't use it, you're passing away peacefully in your sleep at 90 years old, then the money just goes to your family. Okay. It's a higher initial premium, but it's fixed. You're never going to have a price increase. You could do a single payment, you could do a monthly payment. You have some choices there. Some plans would require a single payment depending on which plan you choose. And you could also bypass some health underwriting. I do have guaranteed issue plans in every state but California. So if someone's really having some health impairments, they can get long-term care on an asset-based plan. But if you're really having health impairments, it also could require a single payment. So
That seems
this,
impossible to do that to, again, I don't know anything about this, but how do you bypass health underwriting if, like, let's say you're 600 pounds and you choke down 2 packs of cigarettes and a bottle of Jack every day
yeah.
while you're having a heart attack and you can't remember anything. You've got Alzheimer's, pretty bad.
Okay.
Extreme, but there's somebody out there.
Yeah.
Like,
That's the one exception. If you have a cognitive impairment,
that's
I
it.
may not be able to help because then it becomes a legality issue. Can you really sign on documents when you're having a cognitive impairment? But if you're 600 pounds and you're diabetic and you're not in California, there is a guaranteed issue plan. The multiplier, instead of me handing you $6, for every dollar you hand me, I hand you six normally. Just as an example, if you're 600 pounds and you have really bad diabetes, then I might be handing you two instead of six. You hand me $1, I might be handing you two, or something closer to those kinds of ratios. But there is guaranteed issue long-term care, and it may be a single premium payment. So there are those choices out there.
So you
Um,
might have to throw in a decent amount of cash. That's
Correct.
that's
Yeah,
what you're
that's
saying.
that's exactly right. But there is a multiplier. It's just going to be a lower multiplier for someone who's got a lot of health impairments, aside from any cognitive impairment. Here
Gotcha.
are your
Another
play. I'm sorry. Go ahead.
real quick question to
Yeah,
the previous one.
yeah,
Statistically,
yeah,
you know these insurance providers, you know what they do.
yeah.
What is the likelihood? This is somebody's thinking this question, so I'm just gonna
That's
blurt it out.
I know where you're going. Yeah,
What is the likelihood that these rates are going to increase on the traditional long-term care?
I'm so glad you asked, Jason. I
It's called an
have some.
alley-oop question. Whew.
I included that in this. I have a slide for that,
Okay.
and
Tease it in. Tell us later.
Yeah, I'm going to show you some numbers here because I don't like my clients calling me in their 80s complaining about a rate increase or anything like that. So I want to give full disclosure to anybody, and I have some real numbers I can show you in a moment. But if you're, just say you're 60 right now and you're going on claim at 85, right? I would just say you need to factor in the possibility of a 20 to 40% rate increase. You want to factor
Annually
that in.
or over
That
time?
quite possible. And it could be better than that, but I would factor that in to and it's going to be at some point. So if you're 60 now, you're going on claim in your 80s, I would factor in that kind of a formula. So I'll show you what those numbers are look like in a moment. But here are your players. These are your traditional long-term care players, which is the use it or lose it choices that you can get rates on. Okay, here it is, rate increase history. It's funny you asked that. We did not prepare the question. Here's what Mutual of Omaha has looked like. I have their numbers, and so people are saying that they have gotten better on their rate increases because when they rolled out long-term care, the insurance companies thought people will just eventually lapse. But what happened is no, they held on, they bought and they held on to the coverage. And so back in 97, if you bought Mutual of Omaha long-term care, standalone long-term care, this is what happened. There was a rate increase of 18% in 2015, which is pretty good. They went a long
That's a long
time.
time without it. That's not bad at all.
Yeah, that's 18 years, right? So they,
But
they
if you're
did
on
pretty
fixed
good.
income, hold on. If you're on fixed income though, like great, it's good, but you're still, the cost of everything. Now in 2015 it might not have been so bad, but now inflation is just massively outpacing Social Security and pension. It's the COLAs aren't working. It's just hard.
Yes, and what's tough is healthcare is outpacing inflation. So
Mm.
here are some real numbers when I did the look back on Mutual of Omaha on some of their plans. So here, if you bought again 97, you had a rate increase in 2015. You had another one in 2016. So it would be a major bummer there, right? And then in
Hmm.
2022, you had a 30% rate increase, right? So that was people who purchased in 97. Well, if you purchased in 2010, this is what it looked like. Okay. You've had a 0 to 30 to 38% rate increase. I couldn't get a hard number on that, unfortunately.
Hmm.
And then those who purchased in 2013 have had no rate increase. So I like to think that things have improved, but if you're purchasing a plan today, a standalone plan, I would just say you got to factor in a 20 to 40% rate increase, especially if you're going to be holding a plan for 30 years, 40 years. You want to factor that in. It could be better than that, but I would just consider that kind of possibility.
Assume that you're paying more later and
Correct.
don't try to guess.
Yeah, exactly. Yeah. So I want to give full disclosure. Here's what asset-based care players look like. You have Nationwide, you have Protective, you have One America. This is use it or use it. If you never go on claim, money's still paying out. And so I want to give you some sample rates if that's okay.
Sure.
Am I going too fast? Is this getting overwhelming? How you doing over there?
No, I think, and you know what? If you're watching this obviously this isn't live, but if you're watching this, if you have any questions, go ahead and type them below. We're gonna have Lee's contact information here, so you can go straight to the source. But while this is, unless you're jotting down notes, which is honestly a pretty smart thing to do, but let's say that you found your paper, but you couldn't find your pencil or pen, just go ahead and type them into the comments below, and then. We'll have Lee just kind of circle back and answer them, or I'll try. But I shouldn't be answering any questions about this sort of stuff. Um, so yeah, I think you're doing great, man. Keep up, keep
Okay.
it up.
All right, cool. So now I'm gonna basically give a quick disclaimer. I'm just taking a 60-year-old female, all right, in
Mhm.
Florida, who is in great health. Now, the disclaimer I have to give is some people are not in great health. But I'm gonna give some sample rates for a 60-year-old who's in great health in Florida. And so if we have a 60-year-old in Florida in great health, and we're comparing across the standalone plans. Here I've got Thrivent,
Hmm.
okay? I've got Mutual of Omaha right here, and I've got National Guardian Life. I just put a name for Susan Smith, right?
Sure.
So she's 60,
Good
right?
old Sue.
Yeah, National Guardian calculates based off nearest
Nearest.
age. So
That's
she's
what we do with
61
reverses
again.
too.
Yeah.
6 months to the next year, you get credit for the next year, so you can get a little mo money. Mo money is
Right.
good.
Mo money.
Yeah.
it's hard to do a straight, complete apples to apples
Sure.
here, but I'm trying to as much as I can. I'm giving Susan basically a pool of money. Here I'm
Hmm.
giving her $216,000. I'm saying, hey, Susan, I'm going to just dump this in an account for you. And when you're going on claim, that's the money that's available, right? So that's the way it works. There's just she's buying a bucket of money here.
Hmm.
Now, when it pays out, this is going to pay out based off some limitations. So here she's got a 6,000 per month payout, okay, for all of these. All right, so I got that completely apples to apples. So every one of these plans will pay out 6 grand to Susan Smith for long-term care. All right, but the entire pool is 216,000. Now, I honestly
It's
would
like
do
three
more.
years.
If Susan said to me, "Hey Lee, I got more money to dump on this," I would do it. But I always want to be sensitive to what's comfortable and what's affordable.
Yeah.
So if Susan didn't have a whole lot of budget, I would say this is a basic plan that essentially gets you 3 years of care, okay, based off a 6,000 per month limit. Now she says at some point to me, "Hey Lee, guess what? I am not needing 6 grand. I've got some other alternatives, or my kid's a nurse, or so I only need two or three." That's fine. That's fine. You can choose, but the max you're getting here is 6 grand, and the entire bucket is on these examples essentially 216,000. With National Guardian, it's 219. That's the entire bucket. Okay. Most of these plans, almost every single standalone plan, there are some exceptions, but all of these are going to have a 90-day window, which means that if Jason, you're my doctor, and you tell me, "Hey, Leland, you can't bathe and you can't dress," okay, and you give me that note, and I go back to Mutual Omaha and say, "My doctor Jason says I need help with bathing and dressing." I turn that in to Mutual Omaha. They're going to say 90 days later is when your benefits begin. So 90 days later, I'm going to get 6 grand per month.
Can
Is
you
that
turn it
make
on and turn it off?
What's that?
The 6 grand, can you turn it on and turn it off? So say, or is
Yes.
it like, do you
Yes.
have control over that?
Yeah, that's a great question. Yes, you can. So now most people are not coming back. If a doctor says to me, "You're needing help with bathing and dressing," it's typically permanent. But if for some miraculous reason I recover completely, I can call up Mutual of Omaha and say, "Guess what, guys? I have recovered. You can turn off my benefits." And they can say, "Okay, Leland, you used 100 grand back in 2025, and now you have 116,000 when you're going to go back on claim. So you could turn it off if you recover." That's possible, but that's statistically very unlikely, but it's possible.
Sure.
It's
Okay.
possible. And I should make a quick distinction. That's on these standalone plans. So most plans will allow you to do that. Some other plans may not have you be able to do that. So, but these plans, yes, these will allow you to turn off the claim, and you can turn on later. Here is what premiums look like down here at the bottom. I don't know if you can see this. If you can,
Yeah, it's
okay.
clear.
So these
Yeah.
are sample premiums. So just as again a word of caution, this is for a 60-year-old female in Florida who's in great health. We have premiums looking around 250, basically 250. Thrivent or National Guardian's a little more pricey at 314. And so you would say to me, "Hey, Leland, I'll take the cheap one. Give me the cheapest." Well, this is a little more complicated because it comes down to underwriting. Okay,
Hmm.
putting the right person with the right company. I've had multiple seniors come and apply, and they may not get approved. So I have to move them to a different. That's happening right now. I've got a senior right now who's got some osteoporosis,
Hmm.
and she was declined. Well, now I got to move her over. So I got to make sure I go through and this is more difficult than doing life insurance. I could close my eyes right now and issue out, $100,000 of life insurance for somebody. This is a little more complicated because your odds are you're going to go on claim before you pass, and so it takes a little more work, and there's some things that go into this. But for this 60-year-old female who's in great health and is a non-smoker, looking for 6 grand a month, her premiums are looking around 250, and those premiums would no longer be required once she's getting her benefit. So once she's on
Okay.
claim, she's not paying those premiums basically.
Gotcha. And these are if we go back like big picture,
Yeah,
these are, tell me if I'm wrong, I'm just guessing.
yeah,
Um, but this is the traditional long-term care where the
yes,
price can go up and
yes,
you use it or lose it, right?
correct. So if your wife was on this session right now, I would say, you know what? Her name is Bridget. Is that right?
Yeah.
I would say, Bridget, here's your policy. You're looking at 250 a month. Well, she's younger than 60, but if she was
Yeah.
60, I'd say, Bridget, you're looking at 250 a month. You got to factor in, you're not going to go on claim likely into your 80s. So you're likely going to have a 20 to 40% rate increase here. Just factor
Mhm.
that in. That's just history. But maybe it'll be less, and that's great. But I would just consider that as a possibility.
Got it.
Yeah. Good questions. Any other questions before I move to next slide?
No. And to
Okay.
the peanut gallery, remember questions, type them in below and we'll get them answered. I
Um,
like that. Peanut gallery. Let's go.
this is yeah. This is where you ask whatever. All right. Okay. This is huge. This is huge. Odds of actually, you know what? I want to show something else before I go over here. But let's say Bridget says, you know what, Lee, I don't want to do a standalone plan. Give me asset care. Give me a plan that will have no rate increase, that is going to pay out if I'm going to get hit by a truck, right? Heaven forbid. I'm still going to have just a payout. If
Mhm.
I never go on claim and I'm going to pass away in my sleep, or if I'm getting hit by a truck, I want to have something that's going to pay out. Well, then I can move it over to a asset-based provider. Let me see if I got that here. One second. Let's go. Did I show that? Yeah, I did. Okay. Asset-based.
There we
Here
go.
are your
Yeah.
asset-based providers: Nationwide, Protective, One America. These plans will combo your benefits between your life coverage and your long-term care, or possibly an annuity and your
Mhm.
long-term care. It's going to be a use it or use it. Some way or the other, it's going to pay out regardless if you go on claim or not. My favorite provider for this is Protective. So here I'm going to bring over Susan again. If I put Susan
Mhm.
not into a standalone plan, I'm putting her into a asset-based care plan. Okay. So I'm going to zoom this in a little bit, but you can
Yeah.
see that this is looking, depending on your budget, this might be perfect. So here I've got 219,000. So still same as what we were looking at earlier, basically. The premium is higher, no question.
It's
So you're
200
looking at
more.
she's Susan
Yeah.
Smith, my sample here. She's in perfect health. She'll
Mhm.
be 61, her nearest age, but her premiums are 447. But once she goes on claim, and she has a 70% chance of going on claim, 90 days later, the premiums are waived here. And if she passes away, well, the 219,000 is a payout tax free. So she's going to tax free long-term care benefits or a tax-free death benefit, one or the other.
Are the long-term care benefits for the traditional plan tax-free as well?
Correct.
Okay,
Yes.
so all this stuff is tax-free.
Yes. Correct.
Cool. All
Yeah.
right.
I'm also going to just take one other sample rate for you real quick. And not to get too nuanced, but Protective is a leader in low cost combo plans. It's not
Hmm.
going to be the 7702. Now, some states, this is getting into the weeds, some states like Washington State, which is my home state, have passed a law basically requiring people to buy long term care or pay a payroll tax.
Hmm.
So if someone wants to work with me, I'd have to explain that further if you're still working. Now, if you're retired and you're not working, then it's maybe of no, it's probably no consequence. But if you need a plan that meets 7702, here's Nationwide's combo plan. Still, I've got Susan Smith, my test sample person. Here she is right here.
Yep.
And I've done a combo plan like before. So I've got 219,000 in benefits.
492.
Yeah, but
Okay.
the premium's a little higher. Most of my clients go with protective. I like them, but sometimes it really comes down to underwriting. I have a case right now where I just could not get approved with protective. So it comes down to what's going on with your health, what's going on with your budget, and who is going to accept you. So the case I have right now, the protective said, "Hey, we approved her for life, and her life insurance got approved, but they said we're not doing long-term care." So now I got to
Okay.
move it over to another provider. So it's not just a matter of how much is the premium, but who's gonna approve you.
And you were
Um,
saying with these ones, there's some that don't do health questions, and there's others that do health questions. They'll all knock you out if you have dementia. But this
um,
becomes like,
yeah,
yeah,
cognitive is a toughie. Cognitive is a
yeah.
toughie. That's no question. If you're taking donepezil, the carrier, which is the most common prescription for Alzheimer's or dementia,
Mhm.
they're gonna see that thing. Even if
Okay.
you stop taking it. Some people say, "Oh, I had a guy just like this just yesterday." It's like, "Oh, I was taking donepezil a few years ago, but I'm not taking it anymore." These insurance carriers are going to look back and find that donepezil or whatever cognitive prescription you were taking, but no longer. Maybe you forgot to take it. So, but they're going to find that darn med and they're going to say, "No, thank you."
They can
I
look. So word to the wise, even I know this, and so now you guys, my peanut galleries know this. The insurance companies can do a look back on your prescriptions, so they can
Yeah,
look at
and they look back
history.
7 years,
Yeah.
7 years. So I was taking a very heavy prescription. 20 years ago, I took a very heavy prescription and I got marked up on my insurance 50%. And
Oh,
then I got my health worked out, so I don't have to take that prescription anymore. I went back and I picked up $2 million of coverage right now, and they gave me preferred because they can't see that. I didn't lie to them, but they can't see that
yeah.
darn drug that I took 20 years ago because it's been so long ago. But if you were taking a prescription like donepezil or something heavy duty, anytime they're going to be able to see it in the last typically 7 years. 7 years, I think, is the furthest back that they will go. So cognitive is a tough one. And so it's a matter of your underwriting, it's a matter of your budget and what's going to be a best fit and most comfortable for you. So these are your asset-based care providers. I can't do an apples to apples with One America. There's some other factors there, but these are just some sample rates using a
Mhm.
60-year-old female or 61, depending on how they run the age, in Florida who's in great health. I tell clients all the time, you have about a 7% chance of getting super preferred. So just word of disclosure. That's what I've noticed in my career. But
So
here's
let me
what,
ask you. Oh,
yeah,
sorry. Go
go
ahead.
ahead.
Oh, go into the rates because you're flowing right now. I've got a
Yeah.
question after.
No,
So
go ahead. Those are basically all I have for rates.
okay. So my question is, you get Susan Smith, who's age 60. So theoretically, let's assume that Suey, our girl Suey, is still working, right?
Yeah,
And
right,
so she's paying between 250 and 450, about, depending
right,
on what the smartest thing is for her. She realizes that, hey, she's really healthy now, but there's a history back there, and she just wants to make sure she's not going to the state nursing home. So, and she can afford it now. She's
right.
making enough money, whatever the amount is, but she's got 250 to 500 in disposable income where she can use to save for her future. What happened? Like when she retires, suddenly she goes from all this to fixed income, and this is just it's suddenly this 250 to 450 just becomes a massive nut.
So the carriers have non-forfeiture options.
Okay.
So let's pretend that Susie says to me, "Hey, I can't afford this," and that would be a conversation in the very beginning. I
Hmm.
have a client. It has to be comfortable for you, and it has to be part of really income planning as well, which is a whole other video. But
It's so hand in hand, man.
it really is. This is going hand in hand with your income planning. Absolutely. There's a lot more that we can get into because you could fund this with your regular income. You could fund this with your cash out refi. You could fund this with your reverse mortgage. You could also fund this with your qualified plan. So if you've got your IRA, right, and you're getting a required minimum distribution off that IRA that you really want to just take care of, you could say, I want to partially or fully do a rollover on my qualified plan to fund this, a one-time bang. So Susie could say, hey, Leland, I don't want to pay this every month. I just want to do a one-time bang. I said, you can do that. One time, you're done. You're finished, right? And you could do that with a or IRA rollover, or you could pay one lump sum payment. The benefit of doing a annual or monthly is knowing that those payments are going to be waived once you're on claim. But some people
Mm.
want to do a one-time payment and be done, and if they can afford it, that mentally could be nice. They don't have to think about it. But for someone who comes into financial hardship, there could be a non-forfeiture. So if Susie at 80 says, I can't pay this anymore, then the stoppage of premiums could give a paid up plan. So earlier I showed like 219,000 of benefit. Let's say Susie stops paying it at 80. She could have a non-forfeiture where instead of being 219,000, now it's 180,000 because she
Okay.
stopped at 80. So she's got a paid up plan at a reduced coverage amount. Does that make
Gotcha.
sense?
It does. Another question. So when you look at annuities, there's reverse mortgage money and annuities. It's kind of like sometimes it's smart, honestly. I generally think that the government who makes the rules has never done any of these
Right,
programs.
right.
They're certainly not experts, but they sound good to their followers on TV, I guess. Um, with that said, it's very hard to fund an annuity with reverse mortgage money. Obviously, you have the questions, did this come from a reverse mortgage? Is that the same, or are you saying that you can fund one of these long-term care policies from a reverse because it doesn't have the questions, or like, is there?
There's still going to be underwriting required,
Yeah.
but as far as funding goes, I don't believe you're going to have as much restrictions like in your
Okay.
world, Jason.
Good.
So if you're funding your hybrid, so they also call these hybrids because there's life and long-term care.
Yeah.
They don't ask so much about how it's being funded. But
Okay.
you could do, and this would absolutely have to be disclosed if you're doing qualified money. You would say, hey, I'm going to go ahead and just roll over part of my IRA. If
Okay.
Susie had a big IRA, like a $5 million IRA, says I don't need that much. Just take,
Yeah.
500,000, just roll it over, and she's done, and she can comfortably live in Miami, Florida, which is exploding, right? So she could do that.
Well, if you're in a condo, it might be exploding. Ooh, bad joke. Falling into the surf.
Right.
Ugh.
Right.
Sometimes they land, sometimes they don't. I just say what's on my mind.
Right. So there is a lot more that you could do here. I mean, there's also plans. If Susie says to me, "Hey, I work at some big company. I work at Boeing or
Mhm.
Lockheed Martin or somebody," she could go to HR and say, "Hey, I would like to get group long-term care." So there's also a big push to get group, and that is out there. And uh, I've I've never done that, but I know it's available. But I did group benefits, but I've never done group long-term care. But that is coming more and more popular. People going to
Mhm.
HR say, I want to be group long-term care, or if they're an executive, they do executive carve out. So there are group benefits as well that are available for long-term care. The other thing that's really nice, Jason, about the asset-based plans is instead of Susie giving me receipts that she ended up at Senior Center of America, it can be a cash indemnity plan, which is so great,
What
which
does that
means,
mean in English?
yeah, which means that let's just go back to Nationwide for a second, real quick. So let's say that Susie checks in at a nursing facility or Susie's at home,
Hmm.
right? These benefits are paying out, and we don't need to see, depending on the plan, but I'm talking about the hybrid plans for a moment. We don't need to see receipts. Okay. We don't need to see
Oh,
receipts, which is so nice because if Susie's over here with Mutual of Omaha or one of these traditional providers, they're going to want to see that Susie checked in or Susie's getting a CNA coming in. They're basically
reimbursement.
it's a reimbursement plan, which means that if Bridget, your wife, is having someone come in to take care of you, Jason, when you're 80, and they're gonna go ahead and send the bill to Mutual of Omaha, they're gonna be going back and forth with the billing. Versus if I've got somebody over here with Protective, well, Protective just needs that letter from the doctor saying there's a requirement for help with activities of daily living, bathing and dressing, for example. They're just sending cash. So someone could be in Vegas. I mean, they could be traveling around the world, but as long as we have a doctor's note, they're just sending cash out, which is, I think, personally, I think that sounds so much better. They don't have to share receipts. They don't have to, they can just get the cash and do whatever they want basically with it.
Now that enters into the world of potential irresponsibility. But so we say it's the same thing when you get money through a reverse mortgage. Are there any, I get this question all the time. Are there any limitations? No. Do whatever you want with it, but like you and use it to enjoy yourself. I think that's we touched on that earlier, like really enjoying retirement. That's the whole point of retirement is enjoying. But man, don't fly to Vegas and put it on black.
Please,
'Cause
please don't, because the kids may call
yeah,
me or, but you
no
have
bueno.
you have some freedom here. But here's what's nice. Here's what is a nice benefit. If somebody has a family member, for example, that wants to be the caretaker. Okay,
Mhm.
maybe your family member is going through nursing school or is a CNA or already does home care, right? And you say, "Hey, I want to just let my grandchild or my grandson or I want to let my nephew take care of me." And the nephew's fine with that, right? I want to stay home and my nephew will take. Well, you got to do a cash benefit plan. You got to do it that way. You've got to do a cash indemnity plan because that way there's no receipts involved, and that's fine. But these, like a protective plan, will enable you to do that. So you can have someone who's a family member come in and they can take care of you, right? Or they don't even have to be a CNA. You can just work it out between you and your family member. You're not going to bill protective, essentially.
Okay. That's nice. The
Yeah, that
flexibility.
is.
You don't have to be as organized either.
You
So
don't
like,
have to be as organized. So really, it's everyone's got their own preference. There's pros and cons to each way, but you have a little bit more freedom with, I think, doing a cash benefit plan. Okay, I already showed some sample rates. Okay, this is really interesting. I find this fascinating. Odds of denial. Odds
oh,
of denial. 30% are denied coverage are between 60 and 64. The lady I'm working with right now is 63. She just got denied on the application. All right.
purely
40,
health reasons.
yep, health reasons.
Gotcha.
Exactly. Yes. And so I'm moving the case right now. 47% are denied if they're between 70 and 74. So obviously, the younger you are, the easier it is to
Hmm.
get approved. The older you are, the more difficult it gets. Um, One other thing that's also a hot topic is international coverage. And so a lot of people who are leaving the US are looking like, hey, will this cover me outside the US? And there are plans that can do that too.
So if
Uh,
you're traveling, you mean like
not even traveling.
Expat?
Like some people are they're wanting to go somewhere where the cost of care is lower or just the cost of living is lower.
Okay.
And so the carriers are now open to providing benefit if someone is overseas.
Hmm.
So there are some ways to get benefit if you're no longer in the US. Maybe you're living somewhere else,
Okay.
right? So
Hmm.
that's another hot topic. I think, um, yeah, and that's everything. So there's my info here. If someone wants to reach out, that's my number. There's my email. But that's just an overview. There's a lot more I could get into, but that's just a quick overview on long-term care and your two different options. You have standalone, traditional long-term care, use it or lose it, and you have asset-based care, which is use it or use it. So those are just a quick overview of what's going on out there. There's a ton more that I could get into, but any questions before I let you enjoy the rest of your day?
Yes, I have one. Ooh, the rest of my day. Hmm. Picking up Molly from a math club kind of tournament competition.
Okay.
Alyssa's volleyball. Jay's
Okay.
gonna want to go somewhere. Oh yeah, and
Okay.
then helping people with this stuff. Question actually.
Yes.
It's is there a reason or an advantage? Like, let's say that somebody got a long-term care policy when they're in their 50s or 40s or 60s or whatever,
Yeah.
and they come to you and they say, "Hey, I don't know what I have. Can you help me get something better? I think I'm being ripped off," or a million other questions. Can you generally do that? Can you replace a long-term care policy with another one? Like, should they get a review, or is it kind of like, hey, if you got this thing 5 years, 10 years ago, then you probably got, no matter how good it was then, it's probably the best that you can do.
Great question. Generally, I had this actually just not too long ago. Generally speaking, the longer ago it was that they purchased the plan,
Hmm.
the more untouchable they are. So I have a woman right now in Seattle who came to me with that exact question. And the reason
Okay.
why that question comes up is because maybe they have a premium increase and they're upset about it. I got this plan 20 years ago and now the premium's been going up. It's worth looking at, but typically if it's been 20 years, it's hard to touch. Maybe they need more coverage, especially if they're living in a pricey place
Hmm.
like Seattle, but beating an old policy can be difficult. And the insurance carriers can't just price up a plan without being approved by the state Department of Insurance. They can't just do that willy-nilly. So they
Okay.
have to go back out to the Department of Insurance of each state and say, hey guys, guess what? Our claims were more than we're anticipating, and we need to raise the rate. And they typically will get, it seems like they get approved because they can show the numbers, which is frustrating. But when that happens, the carriers will issue out a letter saying, here are your choices if you want to extend that waiting period. We talked about 90 days earlier. You could extend the 90 days or you could reduce the benefit. So they know that seniors are looking to save or might be having a hard time with a price increase when they're on a fixed income. So there are choices that are provided at a point of price bump, but when they come to me and it's a really old policy, it's hard to beat the rate. What typically would be better, or what might be better, is just changing the plan design, essentially.
Okay. Cool. And then going back to something we both touched on earlier, affordability, and especially going from working to affordability in retirement and income planning. So if somebody's going to come to you and they're kind of younger, they're not retired yet, they're looking to plan for their future, what are we on, like, what rocks do we have to lift up to uncover everything? Like, are we looking at just, we're looking at income now, we're looking at potential retirement income, assets, housing, wealth, all that stuff? Or like, do you have a kind of a roadmap for that?
The more comprehensive, the better. So my license basically dictates that I operate as a fiduciary, so putting the client's best interest first. What kind of retirement do you think you're going to have? What kind of
Mhm.
assets do you have now, and where are you going? So taking the whole picture into perspective, most, and I think they've actually done a study on this, people who have their monthly nut covered, like let's say you need $6,000 a month to live comfortably, just as a round number. If that's covered, that takes a huge weight off of your stress and you typically will live longer. So, talking about income planning, what is the amount of money you need each month and making sure that's secure and one way or the other. And then whatever's left, I think needs to be maximized for your legacy, your long-term care, whatever else that you want to do with your or charitable giving, whatever else you want to do with your life. So having a complete picture of what someone's dealing with is really important.
Gotcha. Yeah, I think that's a good philosophical question too, that I can't tell anybody what the right thing is. It's like legacy versus living now. And I don't know who said it. It's a cliche sort of, but you want to give from strength. And that sort of does get into the reverse mortgage philosophy question of like, hey, do you want to use your home so that you can stay at home and so you can live easier and again feel that weight lift off of your shoulders and smile a little bit more? Or
Yeah,
are you okay with kind of scrimping along and hey, the kids get more? And you're like, well, it's your money, so the kids should get what's left over and we should plan that. But in the meantime, like enjoy yourself a little bit. What
yeah.
everybody's different with that.
I really think what you're doing is valuable, Jason, because a lot of people I talk to, they don't have the assets in terms of liquid assets. I've gone through everything. And then
Yeah.
finally we get to the house. Oh, I've got $1 million of equity. And I just had this conversation like 2 days ago. Someone is like, don't have money here, don't have money there, but I have $1 million of equity in my home. So then it becomes a question of what's more important to you, staying in your home and being healthy and comfortable, or leaving a house, a full $1 million to your kids. Now, I actually don't think a lot of times the kids want the house. They probably want
They
the money.
never, they
Yeah,
almost never do. They just
they
want to
never
sell
do.
it,
It's
whatever.
almost like why would you want the house that you grew up? It just feels like not quite right. You don't want to be
Yeah.
there. But you can still leave your kids a chunk of money and you can still live in your house and you could still get health care. You could still get health care. You could get health care, you can live home, and you can still leave your family, your kids, a chunk of money, and they're not going to be worried about you. And guess what else? They're not going to wipe your behind. They're not going to wipe your behind. And that might be psychologically good for everybody, right?
Want my kids wiping my ass?
Uh,
No.
yeah. And so it's just one. I think it's, and maybe Jason, you might know this better than me. I think it's psychological because people psychologically like the idea of leaving a fully paid property to their heirs. The kids don't want the property. They're just looking for some kind of a cash benefit when someone passes. But you can still do that, live in your house and get healthcare, and you'd probably be much more at peace and comfortable and live longer and live longer.
Yeah.
So that's what I'm noticing right now. When I go through, I talk about financial picture, I go through all these things and maybe there's no assets, but there's $1 million in a house. I'm like, well, are you open to talking about how to use some of that? Not all of it, but some of that to stay there forever. You could stay there forever and get your health care.
Yeah. I think yeah, it is kind of case by case, but everybody wants to stay in their home. Nobody, generalization, but it's a pretty strong one. Nobody wants to go to the nursing home. So you have asset number one, asset number two, asset number three. And I think we've chatted about this, like philosophically, what's the difference between you're draining, like you're going to run through your 401k, you're going to run through your IRA, you're going to run through your piggy bank, you're going to spend all of these things down and out so that you can stay in your home. And then when it comes to your home, sometimes people value that differently. They think, "Whoa, okay, so I've spent this, and the other thing. Like I've spent all my money. Oh,
Right.
but my home, I wanna leave it to my kids." And I'm like, well, I know people say that, but have you actually thought about it before you said it? And I'll actually ask them, like, can you like kind of take me through that statement and how you've come to that conclusion? And then when they think about it for a second, they're like, yeah, you know what? That makes no sense. At least this way I can have my cake and eat it too.
Right.
Oh, all right. Yeah, let's use the house.
Right.
Let's use the house to make things better.
Right. My dad's mom was diagnosed with multiple sclerosis, and we moved her next door. When I was a kid, we moved her next door.
Yeah.
And I can remember picking her up off the toilet seat.
Mm.
And it was sad, it was a sad deal. But if anyone's listening to this and they're wondering like why would I get long-term care? Well, again, if you met me on the street and you hand me $1 and I hand you $5 back, and you can take those $5 and you can get someone to take care of you, it could really help in the future for your healthcare and your mental health and everything else. And in that $1 that you gave me to get five, maybe that comes from a little bit of equity in your home, or
Hmm.
maybe it comes from a little bit of your qualified money, or it comes from wherever. But it's one way to have some peace those last few years of your life. But if you're female, if you're female, not to be too generalistic, but if you're female, your claim length could be a whole lot longer than 2 or even 3, 4 years. Lincoln's longest claim is 9 years. Right now, I think it's been going like 9 years. So if you're female, you could be on claim for a while. Guys typically would die in a year or less, but women they stick around. That's just the
Our wives
stat.
just our
Yeah.
wives just get rid of us. Like, you're not you're not doing anything good. Just go
Yeah.
get to pasture, buddy.
Yeah. That's just a big generalization, but that's what the stats show. So,
That's great.
yeah.
Well, Leland, all right, we've got your contact info. Would you
Yeah.
rather get a call? Would you rather get an email? Like, how do you want?
Anyways, fine. Email's great. Whatever's comfortable for people. I'm work Monday through Friday. So,
Cool. Do you
yeah.
jepfin.com? Is that you can go to your website? Is there anything neat there or
Um, it's just it is my website. Easiest way is just use that email. I have,
just the email?
yeah,
Okay.
I got other emails too. That's the easiest one. So,
Beautiful,
yeah.
beautiful. All right, awesome. Well, dude,
Cool.
thanks so much for coming on. This was amazing. You taught me a lot.
Oh,
Um,
good.
if
Wow.
you're out there, you're watching this, you made it through, you learned a ton. If you can just comment below what you what your biggest takeaway from Leland's presentation was. I think it's like for me, it's learning the difference between the traditional long-term care and the, I guess, more asset-based, although sometimes you can just do monthly payments. But if you've got a couple more dollars to put in, it seems like it's a no-brainer that you would always do the second option, the asset base. Of course, I'm just going off a super, super high level. So I wouldn't ever listen to anything that I have to say about this topic, which is why you're here. But that's kind of like what I get out of it. But even more than that is that because there are so many options, so many ways to go, the health underwriting, like you said, is different from one company to another. The true thing is you don't want to just do this alone. You need to talk to an expert to make sure that you're going into number one, getting the best program up here at a high level, but then also when you get into the minutia and a granular level, you're really like you're getting the right company that's going to, yes, approve you quickly and easily or easy-ish, and you're getting a good deal and you're just in the right spot. So, Lee, I know you can do that. So, if you're interested, if
No.
you're out there in internet land and you're looking for some guidance, then give Lee a shout. I'm sure he'll be able to help you.
Thanks for having me. It was fun. This was fun.
Yeah, this is great, man. Thank you for teaching an old dog a new trick.
Thanks for having me.
You got it.
All
All
right.
right,
Bye-bye.
I'll see you.
Okay.